In the shadowed corners of the financial world, a quiet revolution is reshaping how businesses access capital, and most people have never even heard of it. Private credit, a trillion-dollar market that operates far from the spotlight of traditional banking, is transforming the way companies secure funding, offering a lifeline to businesses that would otherwise be left behind by conventional lending practices. In the complex and ever-evolving world of financial services, private credit has emerged as a revolutionary approach to lending that challenges traditional banking models. Unlike conventional financing methods, private credit represents the nuanced and flexible form of capital provision that has rapidly transformed how businesses access and utilize financial resources. But why do most finance curriculums and analyst training programs ignore private credit and its significant rise in recent years? Well, in today's video, I'm going to be sharing just that. But if this is your first time on my channel, then hi, my name is Cameron Galbraith, and I'm a finance professional in New York City. This video is part of my Wall Street Simplified series where I break down complex topics from the world of finance. I post new videos like this every single week, so make sure to subscribe so you don't miss an upload. And with that said, let's dive into the curious case, private credit. Okay, so private credit fundamentally differs from traditional banking by offering a more personalized and adaptive approach to lending. Where traditional banks often rely on standardized lending criteria and rigid frameworks, private credit providers create bespoke financial solutions tailored to the needs of the individual businesses. These loans are typically negotiated directly between specialized lending entities and borrowers, allowing for unprecedented levels of customization in terms of loan structure, repayment schedules, and financial covenants. If you're not already familiar, a covenant in finance is a contractual agreement or a condition included in loan agreements, bond indentures, or other financial instruments. Covenants serve to protect the interests of lenders, bondholders, or investors by imposing certain restrictions, requirements, or obligations on the borrower or issuer. Examples could be maintaining adequate insurance policies or maintaining a minimum ratio of net operating income to debt service obligations. Metrics like that are pretty standard. The global landscape of private credit has experienced extraordinary growth over the past decade, reflecting profound shifts in the financial ecosystem. What began as a niche market has rapidly expanded into a multi-trillion-dollar industry, with current estimates suggesting the market could reach between $2.8 trillion and $3.2 trillion by 2028. This remarkable expansion can be traced to multiple interconnected factors, including the lasting impacts of the 2008 financial crisis, increasingly stringent banking regulations, and a persistent low interest rate environment that has pushed investors to seek more attractive returns. To provide a more detailed perspective on this growth, it's worth noting that according to PitchBook estimates, the current size of the private credit market stands at approximately $1.6 trillion, including around $500 billion in dry powder. This represents a tenfold increase since 2007. The US market dominates this space, accounting for about $1.1 trillion, while Europe comprises most of the rest. Direct lending represents just over half of the market, with distressed debt and credit opportunities each accounting for roughly 20%. The number of private debt funds raising capital has also surged, growing from around 100 in 2011 to approximately 1,080 in the third quarter of 2023. And that, of course, doesn't even account for the recent boom that we saw in 2024. The post-financial crisis regulatory landscape fundamentally reshaped lending dynamics. Traditional banks faced unprecedented constraints, creating a significant market opportunity for alternative lending platforms. Institutional investors ranging from pension funds to private wealth management firms recognize the potential of private credit as an attractive asset class, offering higher yields compared to conventional fixed income investments. The average returns for private credit strategies have consistently ranged between 8.1 and 14% internal rate of return, making it an increasingly compelling option for sophisticated investors. Major financial institutions have taken notice of this transformative trend. Firms like Blackstone, Blue Owl, and Apollo Global Management have positioned themselves as leaders in the private credit space, collectively managing over $100 billion in assets. These organizations have developed sophisticated strategies that go far beyond simple lending, offering comprehensive financial solutions that provide capital, strategic guidance, and operational support to businesses across diverse sectors. But the appeal of private credit extends far beyond its financial mechanics. For many businesses, particularly small and medium-sized enterprises, private credit represents a lifeline of financial flexibility. Traditional bank loans often come with restrictive covenants and lengthy approval processes, whereas private credit providers can offer more responsive and adaptable financing solutions. Companies can access capital more quickly with fewer operational constraints, and maintain greater control over their strategic direction. Recent high-profile transactions underscore the growing significance of private credit. Similarly, partnerships like the $25 billion collaboration between Citigroup and Apollo signal a broader recognition of private credit's strategic importance in the contemporary financial landscape. The motivations for choosing private credit are multifaceted. Beyond speed and flexibility, businesses appreciate the relationship-driven approach of private credit providers. Unlike transactional bank lending, these providers often develop deep understanding of a company's operational nuances, offering strategic insights alongside financial capital. This holistic approach represents a fundamental reimagining of traditional lender-borrower relationship. Also, current economic conditions continue to shape the private credit landscape. The recent period of high inflation and rising interest rates has created both challenges and opportunities for the sector. Higher rates have put pressure on borrowers, with more than 1/3 of borrowers now having interest costs exceeding their current earnings. This situation could potentially lead to increased defaults and distressed debt opportunities. However, the private credit market has shown resilience compared to other sectors. Direct lending, for instance, sustained losses of only 1.1% between the outbreak of COVID and 2023, compared to 1.3% for leveraged loans and 2.2% for high-yield bonds. The floating rate nature of many private credit loans has allowed lenders to benefit from rising interest rates, potentially offsetting increased default risks. The recent economic uncertainty that we saw in 2024 has also driven more companies towards private credit solutions. Leveraged loan market volatility and banks' reduced willingness to underwrite new loans have pushed companies that traditionally borrowed in the leveraged loan market towards private credit lenders. These lenders, backed by investors with long-term horizons, have been able to provide more stable financing options. Looking ahead, the anticipated interest rate cuts in 2025 and beyond could further boost the private credit market. Lower rates might encourage more borrowing activity while still allowing for attractive yields on floating rate loans. Additionally, the substantial dry powder accumulated during recent slower periods positions private credit funds to capitalize on new opportunities as economic conditions evolve. However, the private credit market is not without potential risks. The relative novelty of this financing approach means that its performance across different economic cycles remains somewhat uncertain. Remember, there are 10 times as many firms engaging in private credit now than there were about 15 years ago. Also, the trend towards covenant-light loans and the potential for reduced investor protections introduces additional complexity. As the market continues to mature, increased regulatory scrutiny seems inevitable. Looking forward, private credit appears poised for continued growth and evolution. The convergence of technological innovation, changing investor preferences, and the ongoing transformation of global financial services suggests that private credit will play an increasingly essential role in how businesses access and deploy capital. The story of private credit is ultimately a narrative of adaptation and innovation. It represents a dynamic response to the limitations of traditional financial infrastructure, offering a more responsive, personalized approach to meeting the complex capital needs of modern businesses. As financial ecosystems become increasingly sophisticated, private credit stands as a testament to the power of creative, flexible financial solutions. In conclusion, the private credit market's growth trajectory appears set to continue, driven by its ability to adapt to changing conditions and provide flexible financing solutions. However, this rapid expansion also brings potential risks, including looser underwriting standards and increased regulatory scrutiny, which will need to be carefully managed as the market matures. As we move forward, the private credit sector will likely play an increasingly pivotal role in shaping the future of global finance, offering both opportunities and challenges for investors, borrowers, and regulators alike. What do you think about private credit? Let me know in the comments below, and make sure to subscribe to this channel so you don't miss a thing. Also, reach out to me on LinkedIn if you want to connect, and I'll see you in the next video. Peace.